Hi, today we are going to discuss regarding how to save millions in UAE corporate tax. Here we will understand how to make your tax minimized. So first of all, for your understanding, we will take some real life example. If you are owner of more than one company, like you are owner of company A and company B. In company A, there is a revenue AED 2 million. In company B, there is a revenue of AED 10 million. Means for your common understanding and common practice, you can say that for the company A you can opt SBR, means small business relief. That time there will be no any tax, as I mentioned here. Regarding second, revenue AED 10 million, then you have to pay tax on the basis of taxable income. As I calculated here, taxable income is AED 1,375,000. That is your taxable income. Means we need to calculate tax on the that amount. So first 375,000 AED, there is a zero tax, and beyond that means 1 million AED, there is a tax at the rate of 9%. Means your tax will be AED 90,000. This is common practice. In common practice, you have to pay 80-90,000 for corporate tax. But as an expert opinion, there is a no any tax will be levied on you, because there is a simple concept of loss transfer to another entity. But we have to follow the UAE Corporate Tax Law guide. Accordingly, we can conclude there will be no any tax. So you need to watch my video till the end for understanding how to calculate your tax zero. First of all, here we will understand the introduction to tax loss transfer. As we discussed, if you have related entities, means you have more than one company, that time you can transfer one entity's losses to another entities. Means group tax burden will be minimized. The law as applicable on you regarding the tax loss transfer is UAE Federal Decree Law number 47 of 2022. I hope you understand. Further, here we will understand regarding the condition for tax losses transfer. If you want to transfer your tax losses and reduce your tax liability, that time you must follow these 5 conditions. First of all, you need to consider if both entity are UAE resident or not. Means both companies should be UAE resident juridical person, means legal person. Second, you need to see the ownership structure. Means one company owns equal to or more than 75% of another entity. And secondly, if there is a third party involved, that time third party owns equal to or more than 75% of both. That is very important for your understanding. This holding should be at the start of the tax period and at the end of the tax period. What this means? Means if your tax period is started from 1st Jan 2024, that time you must have that holding 75% or more. And at the end, means what the end? End is 31st December 2025. That time also you have to hold that 75% or more. Then you can transfer the losses. I hope you got it. Further, neither company is an exempted person. Means in the group entity, neither company is a exempted person or qualifying free zone person. If one of the entity is exempted person or qualified free zone person, that time you cannot transfer your losses. Further, you have to maintain accounting alignment. What is the accounting alignment? Means you have to follow same accounting standard like IFRS, and same financial year. Means your financial year should be same, like 1st Jan to December. Means all companies should follow the same financial year, 1st Jan to 31st December. I hope you got it. Further, regarding limit of transferable tax losses, means you cannot transfer full tax losses. There is a restriction. As I highlighted, 75% is restriction. 75% of what amount? 75% of recipient company's taxable income. Means if one company is generated losses and second company earned the profit, means we have to calculate 75% of this taxable income, not the losses, taxable income. We need to calculate 75% of taxable income. That loss can be transferred maximum up to 75%. After transferring 75%, there is a remaining losses. That remaining losses that can be carried forward by this first entity. I hope you got it. Further, we will cover one real life example. In this real life example, we will understand how can you transfer your tax losses and how can reduce your tax liability. There is a two company X and company Y. Group structure is satisfies 75% common ownership. Both meet all legal requirements. Company X incur AD 6 million loss and company Y earns AD 4 million taxable income. What will be result? We need to calculate 75% of what? 75% of not 86 million, because that is loss. We need to calculate on the taxable income 75%. So 75% of 84 million is 83 million. How much can loss can be transferred? Only 3 million. There is a actual loss is 6 million, but we have to transfer only 3 million, and balance 3 million we can carry forward. I hope you understand. This is simple scenario which I considered according to the real life example. What is the key takeaways here? One, you need to consider the ownership, means ownership should be equal to or more than 75%. And secondly, entity status. Entity status should be UAE resident. Further, what the confirm eligibility? Confirm eligibility, there will be no any company is exempted or qualifying free zone. And third, the what the alignment? Alignment means we need to consider accounting standard or financial year should be same. Further, bear in your mind there should be 75% limit of taxable income, not taxable losses, taxable income. And further, you have to maintain proper document for FTA review. I hope you understand this thing. Thank you for watching my video. If you need any help regarding tax group planning, please comment here.